Module Overview Sale. As globalization deepens, businesses increasingly operate beyond domestic borders, seeking new markets, resources, and cost efficiencies. International capital budgeting refers to the process of evaluating investment opportunities in foreign countries. These decisions are significantly more complex than domestic investments due to exposure to additional factors such as exchange rate volatility, political risk, tax differentials, restrictions on capital flows, and repatriation barriers. This module provides an exhaustive analysis of how multinational corporations, MNCs, evaluate foreign direct investment, FDI, the methods used to incorporate international risk, and strategic considerations in cross-border capital budgeting. Key features of international capital budgeting. 1. Exchange rate risk. Currency values fluctuate due to interest rate differentials, inflation expectations, and political stability. Cash flows generated in foreign currencies must be converted to the parent firm's home currency. Companies face both transaction exposure and translation exposure. Example, if a US firm invests in Nigeria, fluctuations in the Naira-dollar exchange rate affect the dollar equivalent returns. 2. Political risk. Governments can change regulations, nationalize industries, impose foreign ownership restrictions, or alter trade rules. Political instability leads to uncertainties in cash flow realization. Example, a change in government policy may increase corporate tax or revoke tax holidays. 3. Taxation and legal differences. Double taxation, withholding tax on dividends, and repatriation taxes can alter project viability. Understanding bilateral tax treaties and local regulations is essential. 4. Blocked funds and repatriation constraints. Some countries limit the ability to remit profits or dividends to foreign parent companies. This affects timing and certainty of cash inflows to the home country. 5. Inflation and purchasing power parity, PPP. Higher inflation in the host country may erode real returns. Forecasts must adjust cash flows for expected inflation and apply appropriate discount rates. Methods of evaluating foreign projects. There are two principal approaches. A. Home currency. Approach. Forecast future cash flows in foreign currency. Convert each year's cash flow to home currency using forecasted exchange rates. Discount with domestic required rate of return. NPV, CFT foreign text FX 1 plus or home, TIJ text, NPV, as Sumner Farak CFT foreign, and times on text FX tape 1 plus R home, TB foreign currency approach. Analyze project using host country currency. Discount cash flows with foreign discount rate. Convert the resulting NPV or terminal value to home currency using spot or expected future exchange rates. Adjusting for exchange rate risk. Time. 1. Scenario analysis with exchange rate bands. Project cash flows under multiple exchange rate scenarios, e.g., optimistic, pessimistic, base case. 2. Hedging mechanisms. Forward contracts. Lock in future exchange rates. Options. Buy protection against unfavorable rates. Money market hedges. Use borrowing lending strategies to offset exposure. Adjusting for political and country risk. A. Incorporating a risk. Premium add a country-specific risk premium to the discount rate. Adjusted RR home plus country risk premium text. Adjusted as R home plus and text country risk premium. B. Certainty equivalent adjustment. Reduce future cash flows to reflect political uncertainty. C. Use of political risk insurance offered by institutions like MIGA, World Bank, OPIC, and private insurers. Cash flow considerations in foreign projects. 1. Item. 2. Domestic project. 3. Foreign project revenues. In local currency. Subject to exchange risk. Operating costs. Predictable, may fluctuate with inflation or controls. Taxes, domestic rules. Dual tax systems, home and host. Repatriation. Not a concern, may face restrictions or delays. Salvage value, realizable, may be blocked or heavily taxed. Transfer pricing and multinational tax strategy ATS. MNCs may manipulate internal pricing, transfer pricing, to shift profits to low-tax jurisdictions. Affects evaluation of subsidiary projects. Needs careful consideration to avoid regulatory penalties. Real options in international projects. Given higher levels of uncertainty, real options are especially valuable in international investments. Option to abandon if political situation worsens. Option to expand if demand is strong. Option to defer until clarity improves. Practical steps in international capital budgeting. Estimate project cash flows in host currency. Forecast expected exchange rates. Convert cash flows to home currency. Adjust for political, economic, and operational risks. Use appropriate discount rate. Consider repatriation limitations. Use scenario and sensitivity analysis. Practical steps in international capital budgeting. Estimate project cash flows in host currency. Forecast expected exchange rates. Convert cash flows to home currency. Adjust for political, economic, and operational risks. Use appropriate discount rate. Consider repatriation limitations. Use scenario and sensitivity analysis.